Polygon is sitting at 11 cents, exactly at a massive macro resistance level, while retail capitulates. But if you look under the hood at the actual on-chain data, a completely different story is unfolding. We are seeing network fundamentals hitting all-time highs, while the price prints what looks like a bottoming formation on the weekly chart. Today, I'm going to show you exactly why my long-term bag is packed, why I just opened a specific hedge to protect my capital, and the exact invalidation level that will force me to change my entire thesis. If you care about risk-adjusted returns instead of chasing green candles, you need to see this data. Let us look at the current market structure. Polygon is currently trading around 11 cents. Over the past few weeks, the sentiment around this asset has reached peak fear. The broader macro environment has certainly played a part, but specifically for Polygon, the transition from MATIC to the new ticker has left many retail investors exhausted. That exhaustion is exactly what sophisticated capital looks for. You see, when the crowd gives up on an infrastructure play, that is usually when the underlying network quietly starts to absorb real, sticky liquidity. I'm not interested in what the timeline is saying right now. I'm interested in what the settlement layer is actually processing. And right now, the gap between Polygon's market valuation and its network utility is the widest I have seen since the bear market of 2022. But there is a specific trigger in the technicals that changes this picture, which we'll get to in a moment. First, the fundamentals tell us why this 11-cent level matters so much. Let us look at the raw data, because the numbers do not care about market sentiment. Right now, Polygon is processing 7 million daily transactions, with 500,000 active addresses every single day. At an average cost of just over 2 cents per transaction, the network has generated $8 million in fees. This is not subsidized ghost chain activity. This is actual protocol revenue. More importantly, Polygon and Base now control 68% of all USDC stablecoin transactions. Stablecoin velocity is the absolute best metric for real-world adoption, and Polygon is handling massive volume here. We are talking about growth from 31 million transactions in July 2024 to over 613 million by January 2026. That is a 20x increase in 18 months. Why is this happening? Because AI agents are using it. High-frequency automated microtransactions require fast finality and low fees, making Polygon the primary rail for agentic commerce. This is a massive structural shift in how block space is consumed. From a tokenomics perspective, the asset is now deflationary. Over a recent 30-day period, the network saw negative issuance of nearly 15 million tokens, with over 100 million tokens burned historically. The base fee burns are aggressively outpacing the emissions. There are no future unlock schedules waiting to dilute your holdings. On top of that, the staking yield is sitting above 9.5%, which locks up circulating supply. Furthermore, the network recently upgraded its gas limit to 110 million, pushing throughput past 2,600 transactions per second. At this rate, the chain can handle around 224 million transactions per day without congestion. When you combine over 130 million unique holders, giving it an 8% market share, and ranking it 7th globally among Layer 1s, with a network that ranks second in earnings at $3.2 million, you have a highly profitable protocol. It also ranks 6th overall with over 583 million transactions over a 90-day period. To cap it off, decentralized exchange yields on stable pairs like Wrapped MATIC and USDC on Uniswap v3 are sitting at 84%, pulling deep whale liquidity into the ecosystem.
Now, let us align this data with the price action. Look at the weekly chart. We have been trading inside a massive descending channel since late 2024, when the asset hit 75 cents, which was the local top right after the migration. Price has been heavily respecting the middle line of this channel. We recently saw a bounce off this white dotted midline, and we are now hanging around the upper boundaries of this local structure. Currently, price is trading below both the 21 and 55 weekly exponential moving averages. Those red and purple lines are acting as dynamic resistance overhead. But the Fibonacci levels tell a very precise story. If we anchor our pull from the 16-cent low in June 2025 up to the 29-cent high in August 2025, our 1618 extension sits exactly at 11 cents. We are fighting this exact resistance zone right now. The next major horizontal resistance above this is at 15 cents, which perfectly aligns with the upper boundary of our descending channel. Downside support is very clear. The absolute floor is at 8 cents, which marks our all-time low and our last major bounce zone. But here is the critical signal. If you look at the Fibonacci Relative Strength Index below the price action, we are sitting between the neutral and oversold territories, and it's pointing up. More importantly, we have a confirmed bullish divergence on the weekly timeframe. Price made a lower low, but the momentum oscillator made a higher low. This indicates that the downward sell pressure is structurally exhausting itself. So how am I actually trading this? I want to be completely transparent with my strategy. On February 8th, when price was around 9 cents, I told my free Telegram community that I was closing my short-term long trade. The weekly candle had closed below previous support, confirming a lower low. I had already taken my first profit target in January, so closing the rest was simply about capital preservation. However, I kept my entire long-term spot bag because the macro thesis remains incredibly bullish. At the same time, I opened a 1x short hedge position targeting the 6-cent area. This is pure risk management. If the market rolls over, my hedge prints. My stop loss for this short hedge is a weekly candle close above 12 cents. Here's the update. If we get that weekly close above 12 cents, Polygon is officially back in bullish market structure. If that happens, I'll close my hedge short at a small, defined loss and let my long-term spot position run hard. For anyone looking to deploy new capital, waiting for a weekly close above that 1618 fib level at 11 cents is the conservative, data-validated play in my opinion. Once Polygons start moving, I use a strict trailing stop system. When we hit my first target at 16 cents, my stop moves to entry. At 20 cents, the stop moves to target 1. My higher timeframe targets remain 25 cents, 42 cents, and ultimately 60 cents. The synthesis here is straightforward. The on-chain data shows a highly profitable, deflationary network capturing institutional stablecoin flow, while the chart shows a heavily compressed asset flashing weekly bullish divergence at macro support. I'm positioned for the upside, but hedged for the downside until the chart proves the reversal. Never let fear shake you out of a fundamentally strong position, but never let hope stop you from managing your risk. If you found this analysis valuable, please hit the like button and subscribe to the channel. For real-time updates on these exact trade setups, join my free Telegram group using the link in the pinned comment. Also, make sure to watch my previous video on Polygon to understand exactly how we managed that first profitable trade. As always, this is not financial advice, just my personal strategy based on the raw data. Thanks for watching, stay disciplined, and I'll see you tomorrow in the next one.